Hello, welcome to this Q4 2022 AJ Bell MPS service update. I'm going to follow a fairly familiar sort of set of slides to anyone who's watched it in the past. We're going to get a brief overview of the investments range that we run over here at AJ Bell. Shouldn't be new to most people. Then we're going to review the performance of the different types of MPS we run, have a little bit of a review of the markets and how that feeds into the portfolio performance review. And then I'm going to spend a little bit of time talking about the evolution of the process that we've put into changes this year, particularly around strategic asset allocation and how that feeds into the tactical asset allocation. So at AJ Bell, we run two types of portfolio. We run the growth range and the income range. Now, these are risk targeted portfolios, and we run 6 different risk profiles. And we are what's called gold badged against Dynamic Planner. So they run a series of different profiles running from DT1 to DT10. We take the middle 6 of those and we build our core range based upon those volatility bands. There's lots of different ways in which we can implement these portfolios. But the thing to notice is if the number on the DT is one thing, take 2 off that and you get our MPS. So the DT3 is equivalent to our MPS 1, DT6 is MPS 4, etc. Different ways in which we can implement this, but the first thing to note is this is all active management. We are making active positions in our asset allocations. That said, we have a passive implementation. So this uses the lowest cost possible versions of the various funds and ETFs in order to create the strategic asset allocation based upon these different profiles. We have a blended approach that we call Pactive MPS, which blends both active and passive. So this is for those sorts of clients for whom they like the ability to sort of minimize costs by using passive, but they also believe that the actual implementation itself should have active elements within it. Possibly somewhat implied by the fact we have a blended active passive, we also have an active MPS. So this is for clients who wish to be entirely in active products. So this is active management with active products underneath. For those clients for whom it is very important, we also have a responsible MPS range. Again, this uses the same asset allocation framework as all the other different MPSs. It's just that the passive products that we use to implement on this range are MSCI SRI products only. We also have a growth fund range, which is somewhat less relevant to this presentation, but this is basically a unitized version of the passive MPSs. So that means 5 implementations across 6 different risk profiles. It gives us 30 actively managed growth portfolios. Additionally, we also have one growth fund, which is a unitized version of the responsible MPS 5. So that gives you 31 different growth portfolios. On the income side of it, we run what's called income and growth. Now, these follow the asset allocations of MPS 3 and MPS 5 respectively. As with the growth range, we have a passive implementation route for this. We don't have a pactive, but we do have an active implementation route, and we also have 2 income funds. So 2 income profiles, 3 implementations makes another 6 actively managed income portfolios. In total, we're running 37 different portfolios for our core offering. So moving on to performance, there's a few things to note here. This is the passive MPS performance. It's been a slightly unusual year in that in a typical year, you'd expect to see a degree of linearity between the different performance of different risk profiles. What that means is the further up the risk range you go, i.e. the higher number attached to the MPS, the more you deviate from 0. So MPS 6 in a good year would typically do better than MPS 5, which would do better than MPS 4, all the way down to MPS 1. What's happened in this year is it's been a little bit unusual in that it's been a poor year on the whole, although the last 3 months has been okay for investing in general, but it's been worse at the lower volatility target end. And the reason for that is we've had a very severe correction in the fixed income market, which hasn't followed through to a severe correction in the equity market. So it looks a little bit like the equity market and the fixed income market have become a little bit disassociated, and we'll talk a little bit about that later on. But basically what that means is the bond market appears to be telling a slightly different story to the equity market. Also on here, you can see that we have the passive income products, which as a reminder, passive MPS income 1 follows asset allocation of passive MPS 3, and income 2 is passive MPS 5. You'll note that compared to their equivalent growth portfolios, it's been a pretty good year relative, and it's been a really quite good year relative over the last 3 months. And the reason for that is the types of equities that income portfolios tend to be in, or funny enough, income equities. And income equities, there's a lot of overlap between income and value. And this year, it's been very much a good year for value equities as opposed to growth equities. On the active side, it's a similar sort of story in that over the 3 months and 1 year rather, there hasn't been that linearity of performance. So it's not quite the volatility target you're in hasn't necessarily been a great predictor of where you'll sit on the performance rankings. And again, it's for the very similar reasons, which is that the fixed income market has been really quite poor compared to the equity market. What you should notice on this is, and you'd have to go back to the previous slide to see this, but active has been quite poor over the last 3 months and 1 year. We have an excellent research department over at AJ Bell, and over the 3 years we've still done quite well. So on the discrete 2 year and 3 year back, the performance has been quite good, but this year it's been very, very difficult for active managers to create any value. And the reason for that is the types of markets in which active managers do well are typically similar markets to the year we've just had. Unfortunately, they've been in the wrong sorts of positions. I'll talk about what I mean by that in a couple of slides, but basically, value in equities would be a good area for active managers usually, but the types of value equities that active managers have been holding has not been the areas that have done well in the last year. We have a active MPS, as already mentioned. The active MPS being a blend of active and passive, it shouldn't be a huge surprise to note that the active performance is somewhere between the active and the passive. So let's talk a little bit about active and passive barometers. What's been driving, what's been moving for markets? So I've already mentioned that it's been a good year for value, and value tends to favor active. However, active managers haven't done all that well. So what we've had is the best areas to be in the market have been particularly those areas that would be considered violators of ESG mandates. So if we think about oil and gas or any other extractive industry or tobacco or anything like that, but particularly oil and gas, most active managers have been eschewing that sector for quite a long time, because even if they don't have a specific ESG overlay mandate themselves, there will be ESG considerations made in their asset allocation. So therefore, the area where you really wanted to be in the last year, which is really oil and gas in the equity sector and low duration in the fixed income sector, active portfolio managers haven't been exposed there. In terms of how we've done relative to the competition, it's been a very good year, mainly because of 2 factors. Number one, we hold a significant position in short duration fixed income. So what that means is the types of fixed income securities we hold have a short period of time before their maturity. Inherently, that makes them a lot less sensitive to interest rate moves than their long duration counterparts. In the last 3 months, we've somewhat lagged. The reason we've somewhat lagged is there's been a little bit of a reversal of what had been happening in the previous 9 months. So the previous 9 months, we'd been exceptionally well relative, not in absolute terms, but relative to the competition, because we think we've taken a better consideration of the risk profile. In the last 3 months, as is so often the case, when you've had a trend in market, you have a partial reversal. Now that partial reversal has done nothing to diminish how much we've sort of outperformed most of the sector. But nevertheless, it has slightly lowered the degree to which we've outperformed. So thinking about economic and market review, inflation has been a big story of the last year, but we're beginning to see signs that inflation might be peaking. Now, you've got to remember, inflation is effectively an annual measure of price change. So what that means is over every 12-month period, you have what's called an annualizing effect. So the inflation from the 12 months ago, it needs to have continued in the following 12 months in order for inflation to remain very, very high. Because the kind of spike in inflation started around 12 to 15 months ago, although it sort of reached its peak in summer. The high inflation that we were seeing sort of 12 months ago is beginning to fall out of the inflation data. And as a result, we're seeing inflation coming down. And this has led slightly into better than expected growth. So growth is effectively at its heart. It's a measure of nominal GDP minus inflation. So this is a GDP including inflation. Take away your inflation, you get real GDP. Because inflation's been coming in lower than expected, growth only needs to have done as expected at a nominal level, so that the real level of growth is slightly better than expected. Now, this isn't necessarily a cause for cheer, however, because in absolute levels, most of these economic data are quite poor still. Yes, it is true to say that inflation is A, lower than it was 6 months ago, and B, lower than it was expected to be 6 months ago, 6 months later, i.e. the level we're at now was expected to have been higher by forecasters a few months ago. In a historical context, however, inflation is really still very, very elevated. You'd have to go back to at least the early 90s to see inflation anything like what we're seeing now. Growth is marginally positive, somewhere close to zero, which is better than, again, better than what people were expecting, but not exactly what you call bullish. So the absolute levels on the whole are quite poor. In terms of how the market dynamics are working, it's been a good year relative to fixed income for equities, and it appears that equities continue to take this lead. What we would say here is that equity markets and bond markets are therefore telling us different stories, and as we'll see a bit further on, our new strategic asset allocation takes account of this fact, and it's actually tilting us more towards fixed income, because we're beginning to see vulnerabilities appear in the equity market. In the last year, the types of businesses that have done well throughout the year has been fairly constant. This is quite unusual because recall that I said that the first 9 months we had this very difficult bond market, and then the last 3 months things have sort of got a little bit better, i.e. there's been a partial reversal. Typically what you would expect there is the types of businesses that did well in the first 9 months would do poorly in the following 3 months, and vice versa. What's actually happened in the equity market is those sort of value-heavy industries like equity, energy, like basic materials, like financials, did well in the 9 months leading up to this quarter. They've continued to do well relative to other parts of the market in the last 3 months. And at the opposite end, kind of the growth-heavy, what's sometimes referred to as quality, which is oddly enough has a quantitative meaning, those sorts of businesses did poorly in the first 9 months. They've also done poorly in the last 3 months. Again, the equity market seems to be telling a slightly odd story at the moment, whereas the fixed income market, it seems to be quite clear. Talking about fixed income market, universally, it's been quite poor. The best thing to have done is to have been short duration. Unfortunately, that's what we managed to do. But there's been a sharp shift higher in yields across the yield curve, and there's been actually a slight inversion in the yield curve, which means the premium you receive for taking additional maturity risk in your fixed income portfolio has diminished to the point where it's actually gone negative, i.e. you're getting paid more to have short duration bonds than you are long duration bonds. Sometimes this is considered a harbinger of a potential recession, because what it implies is interest rates are high now to cope with what is going on, which is high inflation, but the market is predicting in the future interest rates will have to come down to account for our recession. Now, it could be our recession, but it also could be to account for the fact that inflation might very well come a lot lower in the coming months and years. So I mentioned in the introduction that we would talk a little bit about the evolution of the process. So, and this very much is an evolution. We haven't changed anything fundamental about how we're doing things, but it's just worth mentioning that there is slight alteration in how we've achieved our portfolios. Now, historically, what we've done is we've run a level 1 and a level 2 asset allocation. Level 1 is very, very big, broad asset classes. We split it out to 5, which are fixed income, UK and non-UK, equities, UK and non-UK, and alternatives. But you could even think about it in just 3 big buckets: bonds, equities, alternatives. Now, historically, what we did is we then broke this down into 44 actually quite narrow sub-asset classes, which considered things like in equities, factors and sectors, market cap, for example. In fixed income, it might include index linked, it might include duration, it might include credit quality, etc. So that allowed us to build a very sort of complex set of portfolios. But what it actually meant is we were combining our strategic decisions, which are the long-term decisions that determine how a portfolio behaves, and the tactical considerations, which is how we consider asymmetric risk factors that may be affecting a portfolio. For example, the reasoning why we went into short duration in the first place. Now, what that meant is our tactical decisions were effectively locked into our strategic asset allocation, which meant that if we wanted to make a change sort of intra-year on a tactical decision, that became very, very difficult. And it also meant that annual rebalancing was becoming increasingly onerous, as the complexity of our asset classes and the number of different portfolios we were running meant that we were building out perhaps too many asset classes and losing sight of the purpose of the strategic asset allocation, which is simply to create portfolios that behave in a manner that is reasonably predictable. So as I said, we've evolved this process into what is now the updated one. And basically what this means is we still have that same level 1 asset allocation, but the level 2 asset allocation, instead of having 44 asset classes, we've just narrowed it down to 16 core asset classes. These are the 16 asset classes that we believe can be used for consideration for basically a permanent set of assets for an asset allocation, i.e. what's required to make portfolios that behave in a manner that's predictable. We've then split out what's called the tactical decisions into what we call level 3. And this is where your much more narrow asset classes like sectors, for example, would sit. So what this means is we've effectively disentangled strategic and tactical investment decisions so that the TAA is no longer dependent on what happens. Sorry, the tactical asset allocation is no longer dependent on the strategic asset allocation. Now, we've done very, very well as our performance since we began, particularly in the last year, where risk considerations have really shown themselves to be very important. So we don't want to change the underlying effect of how we create the portfolio. We just wanted to try and disentangle these two different decision processes. So as a result, we've built out a series of processes for the tactical asset allocation, which are onerous by design. So that means that we're still only making what we consider to be worthwhile decisions, but we're no longer locking those decisions into the strategic asset allocation. So I hope that's fairly clear. We think that we can continue to produce portfolios that behave as they should do and continue to make proper accounting for risk. So portfolio changes of 2023. First thing to note is when you've had a very severely negative market for fixed income, i.e. bonds, it basically means later on you have a much improved outlook. What we're saying then is last year, if a bond had a predicted return of 1% per year, this year it might be 3.5%. So what we're doing here is we're shifting towards those bonds fairly meaningfully. A second consideration is that for the first time, probably since the great financial crisis of 2008, cash is more than simply a source of liquidity. Cash in and of itself is now a legitimate asset to hold, particularly in lower risk portfolios, because you've gone from a situation where cash is yield basically zero to actually a fairly meaningful large amount. We've had heightened volatility across markets, but particularly in fixed income, and that favors a slight increase in domestic exposure in order to lower the amount of volatility overall that we're seeing in the portfolios. The process changes have reduced the number of asset classes fairly meaningfully, but that hasn't necessarily contributed to an increase in turnover. Turnover is being driven partly by markets. For example, there are certain positions that were made under the old asset allocation process, which, had the old asset allocation process been carried through to 2023, would have created quite a lot of turnover. For example, it's unlikely we would have anything like as much energy exposure in 2023 as we did in 2022. The removal of that would have increased turnover. That's been slightly hidden by the fact that we've changed the process to remove energy from the strategic asset allocation and bring it into the tactical arena. Overall, however, partly because of the performance has been so good, but mainly because right now we're struggling to see any obvious areas of asymmetry in risk in asset classes, which is a requirement for bringing in a tactical position. We have removed our tactical positions as of right now, and therefore we sit closer to what might be considered the benchmark. Nevertheless, our big focus is, as always, a big focus on cost. So we're continuing to try and seek ways in which we can continue to drive this cost lower. As of right now, the passive MPS can be had for an OTF of around 28 basis points. We'd love to see that to continue going in the right direction. So this is a chart showing the portfolios for 2023. I'm not going to dwell on it too much because perhaps what's probably more important is seeing the changes of the portfolios from 2023 to 2022, rather the other way around, from 2022 to 2023. And here are those changes. Big things to note: AJB 1, 2, and 3 in particular, there's been a fairly substantial increase in the cash, and that's that point I made earlier about cash not just simply being a source of liquidity anymore. You can see on the whole that there is an increase in fixed income. So that's that point I made about fixed income has become a more attractive asset class. Maybe a couple of other things to note. It appears that there's been a reduction in say sterling corporates and sterling government. Yes, that is true to a degree, but as much as anything is we had a broader set of different asset classes under the previous strategic asset allocation. Some of those have been truncated, and that necessarily has moved some of those assets into cash. And then finally, property, given the falls in property valuations and therefore the increase in property yield over the last 12 months, has made property a much more attractive sector than it was this year. That shouldn't be a huge shock that following a bad year, an asset tends to become more attractive because it has necessarily become cheaper. So we've introduced property at the strategic level with the removal of infrastructure to fund that. So in summary, there's been mixed signals from different asset classes. Bonds seem to be saying that we're going to have very high inflation, and it could be very volatile inflation, and there's a lot of uncertainty out there. Equities, for the most part, seem to be still quite sanguine about that. We've reflected that in our strategic asset allocation with that shift towards bonds. However, we continue to see the attraction of having equities as part of a balanced portfolio. We believe that going forward, inflation is going to be volatile and unpredictable. And this is because inflation is no longer simply driven by what might be happening with central banks. Rather, we're beginning to see the real world, non-economic reasons for why inflation might start rising and falling, which is all about supply chains, about emerging bipolarity in global order. This has created a great deal of uncertainty, not just in markets, but just in the world in general. There are the number of potential different outcomes that may happen globally over the next 5, 10 years, or whatever it happens to be, driven by energy policy, driven by, as I say, an emerging bipolarity in global order, means that it's becoming a lot harder to predict where the world might be in, say, 10 years' time. As a result of that, we would say that now is a time not to try and be too clever. And this sort of feeds into why we've really reduce the number of tactical positions we have in place in the portfolios at this time, because frankly, we're not smart enough to know exactly what's going to happen. And therefore, we're just going to try and continue to do what we can do well, which is produce portfolios that behave in a manner that is predictable for clients. Nevertheless, we remain alive to asymmetric risk. Just because we don't have any particular tactical asset allocation positions on right now doesn't mean to say that they won't come back in the future. And if we start to detect issues of asymmetry within markets, then we will act. Finally, you can keep up to date by going on to the Invest Centre website. All the fact sheets and all the commentary are on there. And that's it for the Q4 2022 MPS update.